So what's liquidity? Market liquidity is defined as how easy it is to buy or sell an item without causing a drastic change in price. Something that can be bought or sold quickly and somewhat easy and for fair prices would be considered liquid. So without liquidity, orders can't be matched between buyers and sellers, meaning there has to be a seller at a certain price for that order to be filled at that price. So as we talked earlier, large institutions need to fill their massive orders, so they are constantly seeking liquidity in the market. Liquidity is basically a pool of orders resting at a specific price level waiting to be filled. There are many Forex coaches that don't put much thought into liquidity. I just don't get it. Not understanding liquidity is the same as not knowing market structure. And it's the reason why retail traders lose so much money in Forex. My trading strategy is all based on liquidity, and I only became profitable on my trades after fully understanding the concept. So it doesn't matter if you're trading stocks, Forex, buying houses, or selling fidget spinners at the end of the hype. When everyone is doing something, it's a signal that the money is stepping in. Warren Buffett once said, "Be fearful when others are greedy and greedy when others are fearful." Our concept is called smart money mostly because we understand liquidity. Simply put, if you can't spot liquidity on your charts, you're basically being used as liquidity to fill someone else's order. So after learning this concept, you realize why most break and retest pattern strategies don't work. As the market moves and structure are created, the price is also creating these pools of liquidity to be filled. So you'll be able to spot these liquidity areas by looking at swing structure, equals highs and lows, as price chains are formed, etc. So behind or above these forms of the structures, there will most likely be orders waiting to be filled. So if we think about it, these patterns are created in the market to lure people to place their stops at specific places and to fill those pools of liquidity. That's why when price gets to those levels, the big orders will be filled, creating the spikes in price. As we map our market structure and find our supply and demand zones, we also need to be spotting these liquidity areas. And there are two main ways in which we can do that: by using inducement or sweeps of liquidity. So inducement works as a magnet of price. As the market structure is formed, the price will leave these induced areas behind to then later come back to fill those orders. It even seems like it's telling you where to look to find these high probability zones. The sweep of liquidity is the act of taking the liquidity. So the price can sweep the liquidity of an induced zone or sweep the zone itself in order to grab liquidity. We can then use this swept area as a confluence when choosing our high probability zones to trade from. Together with the other tools we have learned in this class, inducement and sweep will also be one of the main confluences we use to take trades. We will go over this concept in more detail in our trading strategy section.